Hi and welcome to ECCB Connects. This week we'll be looking at banking services. We'll explore the types of accounts that are available to you, the citizens and residents of the Eastern Caribbean Currency Union, and we'll examine some common banking terms as it relates to your savings account. Stay with us. We'll continue in a moment. Thanks for staying connected with us. Our guest this week wears several hats. He's Mr. Baldwin Taylor, General Manager of the Bank of Montserrat. He's also the Secretary of the Antigua and Barbuda and Montserrat Bankers Association and the Secretary of the ECCU Bankers Association. Mr. Taylor, welcome to ECCB Connects.
Thank you very much, Shumalon.
Today, of course, we're going to talk about an interesting issue, banking. Banking service, of course, is very important to the people of the Eastern Caribbean Currency Union. Our people are very serious about their wealth, and most individuals and families store their wealth at our commercial banks and, of course, other financial institutions throughout the region. But we are going to focus on what happens at the commercial banks. Now, let's start with the types of accounts. And we're looking here at the savings accounts. What are the different types of accounts are available to the people of our region who bank within the ECCU banking system?
Okay, thank you, Shumalon. Generally, commercial banks offer customers a range of accounts to choose from. One type that is common across all banks is a regular savings account. That's a mandatory savings account that all banks will offer. And that usually pays the minimum savings rate that is offered, mandated by the central bank at 2%. Other banks have various types of savings accounts targeted at different segments of the market. For example, a bank may have an account that is set up specifically for senior citizens that would offer various benefits to people who have reached the age of retirement, who have worked hard and deserve some type of benefit for their years of saving and working hard. We also have accounts for children, for example, that would encourage children to develop the good habit of saving. And those usually pay slightly better interest rates sometimes to really encourage our young people to develop the habit of saving. And there are other instruments, for example, that may help people plan for retirement. So somebody who may not have the discipline to keep the money saved on a regular savings account can invest it in, for example, a retirement savings plan that will restrict or put a little more control on how withdrawals are made on those accounts, really to help people accomplish their goals of building for retirement. And those are just a brief summary of the types of accounts that are available to customers that they can either plan for retirement, plan for education, build a habit of saving in children, or when they get to a more senior level, in life to be able to benefit from a senior's account.
There's something for everyone.
Certainly.
And I guess the key here is for an individual to know which type of account suits their objectives, their savings objectives.
That would be correct. I try to look at a customer from a life cycle perspective. When I'm 9 and 10 years old, my needs would be very different from somebody who's 55 or 60. When I'm 35 years old, my needs might be very different from somebody who's 18. And banks generally try to cater to the needs of all customers and the various segments of their life.
Let's now move to common banking terms. Of course, within the banking sector, you have the language which governs how you operate. And we look at them in three categories: savings, loans or mortgages, and credit cards. We'll start with savings. And of course, with a savings account, we're looking to build on what we already have, and that comes through interest. What are the different types of interests that are offered on a savings account?
Generally, when a customer opens an account, they are promised a specific rate of interest. That rate is usually a fixed rate of interest that you open that account, you maintain a certain minimum balance, and I pay you either 2%, 2.25%, whatever the rate is quoted by the bank. As long as the customer maintains that minimum balance on the account, then they are guaranteed to receive the rate of interest that is promised by the financial institution. Some institutions would pay interest on a quarterly basis, some would pay it monthly, some would pay it annually. It is important for a customer to understand when they open the savings account, what is the interest rate that is tied to that particular account, and what are the periods at which the interest rate is going to be paid.
Okay. Interest is calculated. You can have accrued interest or compound interest. Explain these two, and if possible, use a practical example. So for example, if I have $500 in my account, and that is, you have accrued interest on that particular account, how does that work?
I probably need to explain what accrued interest is to help you better understand what that is. When we hear accrued interest, in accounting, we have to account for the interest at the point in which it is incurred. So if we've agreed to pay a customer 2% interest on the account, and that is paid quarterly, it does not mean that interest is not worked out on a daily basis. So a customer would have an account, say for example, an account of $1,000, and the interest on that account is 2%. Every day that the customer keeps that account with the bank, they are paid whatever portion of that interest is due to them. Now, it is not paid directly into the account at the time. We account for it. We know that person A has an account with $1,000 and the interest rate is 2%. So the daily interest on that would be X or Y, and that is added up until it is eventually paid at either the end of the month, at the end of the quarter, at the end of the year, whatever the payment period on that loan is. So if I can use that example as well for a loan, a customer may have a loan, and they would repay the loan at the end of the month. Every month you get your salary, your loan is paid. But it does not mean that interest does not continue to accrue on that loan. Interest continues to accrue, and it is eventually charged to the loan at the end of the month. So if, for example, a customer pays off the loan in the middle of the month, the interest is worked up to the day that the loan is paid. And that really is what we call accrued interest. Now, there's accrued interest revenue, which is what banks would get from the loans that they have, and accrued interest expense, which is the interest that we pay to our depositors for the loans that they have. Now, we spoke a while ago about compound interest. Compound interest is really adding interest on interest. And if I can use a fixed deposit, for example, and many people refer to it as a fixed deposit, as term deposit, a certificate of deposit, many names for the same thing. It may have an interest rate of 2% if you keep your funds locked for 1 year. Or some people may decide, I want to keep my monies there for a 5-year period because I'm saving for my daughter's education or my son's education, and this is what I'm going to use to fund that education. Some people may choose at the end of the renewal period, which is usually 1 year, to take that interest. Other persons may choose to leave the interest on the fixed deposit. So when it is renewed with the principal, which would be the $1,000, and the interest that would be added onto that account at the end of the year. So by year 2, you are now getting interest on, let's use an example of $1,000, and the interest rate is 5%, which would be about $50. If the interest, the facility matures at the end of year 1, you would get your $1,000 principal investment plus the $50 interest. You roll it over for a second year. At the end of year 2, you are now getting interest on the $1,050, and then you can continue to add that over the 5-year period, which would essentially help you earn a greater return on that investment.
Mr. Taylor, can a customer negotiate what type of interest he or she wants on an account?
Interest rates are usually fixed depending on the type of account. And I'm assuming we're speaking specifically of deposit accounts. So you may have a deposit account, a regular savings. That rate is fixed across the banks. You normally have the seniors account. It is usually a fixed rate on that particular account. The same applies to the account for minors, or, for example, an education savings plan. It is usually a fixed amount that has a fixed rate that has to be applied. Where I think there's sometimes latitude is where, depending on the size of a deposit, the customer that you have, sometimes with a fixed deposit, a bank may choose to negotiate with a good customer if it is not a deposit that the bank would want to lose. But for the savings account, it is usually a very fixed rate on those accounts.
And in terms of the type of interest, because you spoke about accrued interest and compound interest, is there any room to negotiate that maybe I want accrued interest or compound interest on my account?
The customers have the option of indicating to a financial institution. For example, if a customer has a term deposit with a bank, they can say at the end of or the maturity date of that investment, I don't want my interest to be rolled over with my deposit. You can now take that interest, put it onto a savings account, and then you can renew it for the fixed amount that I initially started off with. Other customers may choose to want to roll it over. It all depends on what the customer's needs are and what they have that particular investment for.
On a bank statement, or sometimes when you go to the ATM, your printout would show account balance and available balance. And usually these two figures are different. Please explain.
On almost every savings account, there is a minimum balance on that account. So, for example, if somebody banks with one of the banks in the region and they've opened a savings account and the minimum balance on that account is $100, the customer must maintain that minimum balance at all times. When they go to an ATM, they would have received their salary. They would have received a salary of $1,500. If they go to the ATM and they do an inquiry into what the balance on their account is, it would tell them your available balance is $1,400, and your current balance is $1,500, because you actually have $1,500, but because you must maintain a minimum balance of $100, that $100 would not be available to the depositor if they were to try to access that through the ATM.
Account history.
The account history really refers to a log of all of the transactions that would have happened on a particular account from one period to the next. It might be from when somebody gets their statement, it would provide a history of the account from one statement period to the next. We can get more detailed statements that may provide a transaction history for an entire year, or if a customer wants, they can try to get the account history from the time the account was opened till the time the current date. It really provides a history of all of the debits, all of the credits that would have gone through that account from one period to another.
Let's look at one last term under the savings category. Annual percentage yield.
The annual percentage yield really refers to the rate of return that a customer will earn on a particular investment or savings account. And it really takes into consideration what we spoke about a while ago, the issue of compound interest. So somebody has an account that pays a rate of 2% or a rate of 2.25%, for example. But if that person continues to invest the interest in that deposit, so you have a fixed deposit, it matures after 1 year, the interest rate on that is $50 or $100 or $500, and you roll that over into the next year and you get paid interest on it again. At the end of the 5-year period, when you eventually take out your deposit, if you work out the interest, it would be a lot more than the 2% that would have been quoted, primarily because you have invested the interest into the deposit every time it has matured. And in so doing, you would have been able to get a higher rate than what was actually quoted on your deposit, initial deposit.
Mr. Taylor, you have helped us to understand some important banking terms as it relates to our savings and loans. Before we wrap up, banking, of course, we know is an important service in our region. However, sometimes customers feel like they're being treated unfairly by banks. What's your response to that?
You know, banks are always perceived as the big bad wolves. And what I would say to customers is try to have a conversation with a bank. I think banks are very understanding, always open to conversation, always open to trying to help customers out. If a customer is going through a difficult period, rather than run from the bank, the advisable thing to do is to come into the bank proactively and have a conversation. Explain your circumstance to your banker so that they can sit with you, work out a solution, and to determine, listen, this is where you have found yourself. This is what we can do to get you out of the situation. I think we have to work together. We need the customers to survive, and it's about building a relationship to help both of us grow. And that can only be accomplished when there's a cordial relationship between the customer and the bank.
Mr. Taylor, thank you very much for speaking with us on ECCB Connects.
Thank you, Shemalon, and thank you for giving me the opportunity to be able to explain those to our customers.
Celebrating ECCB at 40.
Did you know that the EC dollar has been pegged to the US dollar at a fixed rate of EC $2.70 to US $1 since July 7th, 1976? Now you know. Celebrating ECCB at 40.
Here's where we end this week's episode of ECCB Connects. In this program, we looked at types of accounts that are available to you, the citizens and residents of the Eastern Caribbean Currency Union. We also explored some common banking terms as it relates to your savings account. In our next program, we look at banking terms related to loans, mortgages, and credit cards. Thanks for watching. See you next time.